Welcome back to Moody's Upgrades India, the market verdict. We just heard Big Bull Rakesh Jhunjhunwala with his views on the Moody's upgrade and what it means for India and, of course, listed stocks in the country. Now let's get your views from Arvind Sanger, Managing Partner at Geosphere Capital Management, and what he thinks of this upgrade.
Well, it's certainly a pleasant surprise. I don't think anybody was expecting it at this time, especially given that there were some nascent signs of inflation. But I think Moody's is making a long-term call, and I think therefore kudos to them and kudos to the government for getting the recognition for the long-term benefits of some of the moves like GST, and so that's I think the main takeaway. I still don't think that we can, from a short-term trading standpoint, and I mean by it over the next 3 to 6 months, we can use the crutch of the Moody's upgrade to stop worrying about some of the risk factors out there.
Okay. Like oil prices?
Yeah, like oil prices. Like oil prices, like inflation, like, the deficit to the extent that the government has to cut excise to not get the full impact of oil prices on the consumer. And there's an election in 2019, so how will the pump priming in terms of any deficit spending play out? So I think there are plans by the government. I've spent the last few days meeting with different people, and one of the things I understand is that there are some plans for some serious disinvestment type of, whether it's the HPCL, which has been long-standing, but others that might provide more of a cushion for the government to be able to do extra spending without busting a hole in the capital discipline or in the budget discipline. But I still think that the oil prices also remain a risk factor.
A lot of investors are looking at now mid-cap stocks. If growth is around the corner, maybe higher beta over there?
Yeah, I mean, I don't think they've just started looking at mid-cap costs. The mid-cap stocks have been on fire for the last, several quarters. So I think that mid-cap is clearly seen as the preferred place for some of the growthier stories. And I think part of what has happened is that when you had the macro story looking less robust, you were finding mid-cap sectors or companies that were doing much better. So they've been leading the performance. And, if you look at the banking space, the NBFCs we have been leading in the financial space. And now, of course, the PSUs have had a huge move in the last few weeks. So I think that, Sandeep said something which I thought was very interesting. I too believe that, at some point one has to look at some of the more, global players, which we've ignored. Yes, the India earnings recovery is still the favorite theme, but the India earnings recovery theme, the valuations are pretty rich. So I think, in pullbacks, that's a place to buy, but I think that to the extent that some of the global-facing IT names or some other, smaller cap subsectors that have been left for dead, there could be some opportunities there. At least we're looking at those if there is a opportunity in a pullback, those could be.
Yesterday I was speaking to Rhythm, and one of the things that Rhythm said is that at long last, probably after 10 years, the cost of capital in India is below the return on equity. And with this, upgrade and therefore the rupee getting stronger, cost of capital perhaps falls a little more. What's your sense? He says usually when that happens, it's a harbinger of the capex cycle.
Well, I don't know that I have the statistics to back that. I find it hard to believe that companies start spending money when their cost of capital has fallen below their,
probably an added incentive.
Yeah, but at the end of the day, companies invest because they're seeing returns on investment because they have capacity needs and the market's demand is there. So I think that part of what will drive the corporate capex cycle, in my opinion, is this whole bank recapitalization along with NCLT. If we can move that forward quickly. And move some of those assets from the distressed hands into real hands, that clears up the deck of one part of the this is a capex that is not new capex, but it's going to unlock, in my opinion, some of the risk-taking capability of some of the corporates once that.
Is the metals rally well and truly on, Arvind? Globally, it's been the case.
Well, it is. I mean, I think what's going on is, and it's kind of a little bit of a contrast, unfortunately, with India, is that China is cracking down a lot of capacity because they're worried about the environment. and about the air in Beijing and what have you. Just by way of aside, the readings in Beijing are 1/5 in Delhi, but they're still concerned about.
I wonder what the Chinese are thinking about Delhi if they've had a recent visit.
Yeah, but the reality is that they are cracking down. So steel, a lot of capacity is gradually being shut down, and some of that is temporary, seasonally. Some of that is more structural, and so you're seeing that in areas like aluminum, and you're seeing it in steel. So those are sectors that benefit. And the demand side, we've seen this in oil and we've seen this in metals. Global growth is better. Global demand is better. And therefore, that is also, so along with the Chinese capacity reductions, and China is a very important part of the capacity reduction story, and the demand globally, continuing to look stronger. And, if inflation is coming back, which it seems like it is, it's not all bad. I mean, the metals are part of the beneficiaries of inflation.
That was Arvind Sanger in conversation with us earlier. Now it's time to get you our next big market voice, Sandeep Bhatia, head of Equity India at Macquarie Securities Group. Let's see what he makes of the Moody's upgrade.
I think it's very good news. It's come after 13 long years. So it's, I think, a welcome headline news. Does that change my view? Does that change a long-term investor's view? I would not think so. I think India has been doing the right things for a long time. Unfortunately, time and again, there are these, a lot of pressure points come that this is wrong and this will take the economy off the rails. I think nothing like that is happening. In fact, what we are doing structurally for the last couple of years has put India on a much stronger footing. And I think this rating upgrade, I always have believed that rating upgrades or downgrades are mostly lagging indicators of what is really happening in the real time in the economy. And in the real economy, things have been improving structurally for India, and this is an acknowledgement of that. So does that mean that, yes, since yesterday people were negative and today they'll get positive on the back of this rating upgrade? I don't think there's going to be one dramatic shift because of this one point. Yes, I would think it will be an acknowledgement that a lot of difficult decisions which may have had short-term costs have been taken, and which is why the economy is now on a higher credit rating. And that's it. I don't think people's investment decisions change on the back of one headline.
Where are we in this bull curve? Which part of the curve are we in? This bull charge that's been sort of ensuing for the last 1 year or so. Are we in the early part of the bull? Is this the middle? I mean, how does it look? Because I don't want to draw parallels in comparison with 2006-07, but that's the last memory that we have of a serious bull charge, right?
I think we are still in the first half of this bull charge. I think this government has a lot of legs, and I think for the next 18 months, I would think the focus will be entirely on the economy. Every media interaction that I have, the only question is asked is when is the growth coming back? When is the capex cycle coming back? When is the earnings cycle coming back? I think that question needs to be answered, and with the speed at which some of the policy changes in GST rates have come through, signals to me at least that the government is very serious about the economy. I don't think from here to, let's say, June of 2019, we'll have any measure which will hit the economic growth rate. Whether that means that the capex cycle picks off as of March, or the capex cycle, as some industry leaders think, will pick off of March 19. It's all finally one's opinion against the other. I think the underlying trend is that the government of India will be the biggest spender, and the consumption growth should pick up from here onwards. And the government will do everything to ensure that this happens.
Sandeep, the question to you is, how does this rejig your portfolio?
I think just the announcement doesn't rejig the portfolio. As I've said, we have always been positive on banks and consumption. And that is something which, as a thesis, continues. I think the only thing I will say is that look at the laggards now. So it's not a great day to talk about IT. But I think if we get pressure on IT, for any investor which has over a 2-year time frame, IT may be a good sector to look at, and again stick to the large leaders such as TCS and Infosys. So that's something which is clearly something which you should look at. Again, the capex cycle plays. In fact, if you look at our conference, the highest number of meetings we have seen are for mid-cap names and for capex cycle plays. So all the fund managers are now looking outside the leaders. Everyone knows the story of the banks. Everyone knows the story of the consumption stocks and so on. But people do want to see whether in the real economy there are still some new stories that they can explore. So which is to me the biggest learning, that the highest number of meetings, for chock-a-block meetings, came for tier 2 stocks, tier 2 kind of companies. So that's interesting. And the other thing which one should do is take every dip in the market as a buying opportunity. There are some concerns, especially on the oil price, which has been highlighted. I don't think that oil price goes to a completely new level, which is above $80 in my view, because there will be a supply side response, especially from the US, in 6 to 12 months if prices go up above 80. So to that extent, I would still think that we'll have an oil price scenario which will be between $50 to $80, a big range, but it will not be in the danger zone for the Indian economy. So every dip in indices is a reason to buy. We still have a long way in terms of earnings growth and GDP growth to come through. So buy this market at every dip.
Okay, so buy the dips. That was the call from Macquarie. With that, it's a wrap on our special show, Moody's Upgrades India, the market verdict. Thank you very much for watching.